In October 1987, the Dow Jones hit an all-time high. 2 weeks later, it lost 22% in a single day. In January 2000, the Nasdaq closed at a record. Tech stocks had never been stronger, valuations had never been higher, and for the next 30 months, the index fell 78%. December 2007, the S&P 500 peaked, employment was solid, GDP was growing, credit was flowing. 16 months later, the financial system nearly collapsed. Here's what connects them. In each case, the top wasn't a moment, it was a process. Markets didn't crash from weakness, they crashed from exhaustion. The price kept rising, but underneath, the structure was already changing. Professional traders call this a rolling top. It's not a collapse, it's a rotation. Strength in one area, quiet deterioration in another. The headline stays intact, the plumbing starts to crack, and the danger wasn't in the price, it was underneath it. Welcome to the wealth timeline, where money, power, and history quietly shape the world around us. Because what looks like a crash to most people actually started months earlier, and understanding that difference is what separates positioning from panic. Picture the trading floor in October 1987. Stocks had doubled in 5 years. Volatility was low. Institutional money was flooding in. Portfolio insurance, a new financial technology, promised to protect investors from downside risk automatically. It was engineered stability, mathematically sound, widely adopted. At the time, this looked like progress. What no one questioned was the structure holding it up. Portfolio insurance was born from a real problem. In the early 1980s, pension funds and institutional investors faced a dilemma: how to participate in rising markets without catastrophic downside exposure. Traditional hedging was expensive, static, inflexible. Two Berkeley professors, Hayne Leland and Mark Rubenstein, proposed a solution: dynamic hedging. The strategy was elegant. As stocks fell, the system would automatically sell futures to limit losses. As they rose, it would buy back in. It was rational. It was liquid. And by 1987, it controlled tens of billions in assets. Policymakers believed they had engineered out systemic risk. Investors believed they had found a way to stay fully invested with a safety net. Liquidity providers believed the futures market could absorb whatever flow came through. Each assumption was reasonable. Each was built on conditions that hadn't been tested under stress. It worked, but only under conditions that would not last. By mid-1987, portfolio insurance had become institutional infrastructure. Pension funds used it. Mutual funds used it. It was standard risk management. And because it worked, more capital flowed in. More strategies were built on top of it. The system expanded. But with every participant, the strategy became more crowded. With every dollar added, the required liquidity deepened. With every day of calm markets, the implicit assumption strengthened that selling could always be gradual, orderly, absorbed. This was the unintended consequence. The insurance wasn't distributed across time. It was synchronized. Everyone held the same exit strategy, and no one held the other side. Meanwhile, prices were improving. Valuations were stretching. But the plumbing, or the actual mechanics of who would buy if everyone sold at once, it was changing. Late cycle markets often look like this: strength on the surface, fragility in the structure. The stronger it became, the harder it was to stop. In early October 1987, interest rates began to rise. It wasn't dramatic. The 10-year Treasury yield moved from 9% to 10%, but that was enough. Bond prices fell. Stock valuations compressed slightly. And portfolio insurance triggers began to activate. At first, the system worked as designed. Sell signals were generated. Futures were sold. Losses were contained. But the selling didn't stop. As prices fell, more triggers activated. As more insurance sold, prices fell further. The feedback loop had begun. And because the strategy was so widely adopted, there was no natural counterparty. No institution waiting to buy. No liquidity cushion. By October 16th, the market had fallen 5% in a single day. Nothing collapsed. And that was the problem. Monday, October 19th, 1987. Markets opened down. Portfolio insurance systems immediately began selling futures. But the futures market couldn't absorb the flow. Prices gapped down. Arbitrage broke. The connection between stocks and futures, and the mechanism the entire strategy relied on, stopped functioning. At that point, the insurance stopped being insurance. It became forced liquidation. Market makers stepped back. Liquidity disappeared. And the cascade accelerated. Not because of fundamentals, not because of news, but because the structure designed to prevent losses was now creating them. The decision to adopt portfolio insurance wasn't reckless. It was logical, institutional, prudent by the standards of the time. But it was built on an assumption that liquidity would always be there when you needed it. From this point on, the outcome was no longer optional. The Dow fell 22.6% that day. $500 billion in market value vanished. But the real cost wasn't the decline. It was what happened next. Retail investors, pension funds, and smaller institutions absorbed the losses. They had relied on the system. They had trusted the insurance. And when it failed, they had no alternative. Meanwhile, large banks, proprietary trading firms, and those who understood the structural fragility beforehand quietly repositioned. Some bought the collapse, others hedged in advance. The wealth transfer was silent, structural. Regulatory responses followed. Circuit breakers were introduced. Portfolio insurance was abandoned. But the lesson wasn't learned. It was repackaged, because the underlying pattern didn't disappear. Over the next 2 decades, variations of the same structure reappeared. Long-term capital management in 1998, the housing-linked derivatives in 2008, volatility targeting funds in 2018. Each time, the mechanism was different. Each time, the logic was the same. Engineer safety through synchronized behavior, assume liquidity will hold, and discover the assumption only when it's tested. Power quietly shifted, financially, institutionally, structurally, to those who understood that late cycle stability often masks concentration risk. This isn't historical curiosity. It's a framework. Because right now, trillions of dollars are managed through similar structures. Systematic strategies, risk parity funds, volatility targeting algorithms, all built on assumptions of liquidity, all synchronized. Prices are the headline. Plumbing is the story. The yield curve spent 2 years inverted, a historically reliable signal of stress building in the system. When it uninverted in late 2024, many celebrated. But uninversion doesn't mean safety. It means the stress moved. Often, it's the moment before liquidity conditions shift. History doesn't repeat events, it repeats incentives. Late cycle psychology follows a pattern. Complacency rises as volatility falls. Crowding increases as strategies work. Structural fragility builds quietly while surface conditions look stable. This doesn't mean a crash is imminent. It means risk awareness matters more than forecasting. It means positioning and sizing matter more than prediction. Professional risk managers don't ask, when will it break? They ask, what happens if it does? They stress test assumptions. They monitor plumbing, not just price. They stay positioned for outcomes they can't time. 2 takeaways. First, systems break where everyone assumes they won't. The most dangerous risks are the ones baked into standard practice, invisible until they're not. Second, human behavior compounds structural fragility. When everyone believes the exit is clear, the exit disappears. You don't need to predict the next crisis. You need to recognize when the conditions look familiar. If this helped you see the system more clearly, subscribe to the Wealth Timeline, because the next story won't predict the future. It will help you recognize it